Hey Moneymakers, I'm Joshua Bellinger, and in a second here, I'm going to show you the best options trade that you could put on in your Robinhood account that you could do today and can easily turn into 100%. So let's take a look at the chart here. So right now we're just taking a look at a basic chart. Now, a lot of traders trade differently. My approach to trading is there's historical data that can create probabilities or there's watching the tape to look for future and what the future is predicting. So this one's going to be more on the future prediction of where we think prices or what we are seeing positioning in the options market that prices possibly could go lower here. So we're looking at HTHT, and you take a guess on how to pronounce this, but they're in the hospitality business. It's an ADR, and they're in China. So you can see here that there's a lot of gaps, and it's gaps because the pricing of the ADR is trading overnight when the US is closed. So we get all this kind of back and forth. Now, if you take a look here at the chart today, we had a big move lower here. This is a very volatile stock, so yeah, big is relative to what the volatility overall in the product is. So it's just a volatile stock and gap risks happen. So let's take a look at the future possibility that we're looking at here. So again, one of the things I follow the money, high impact trades. What we're looking at here is the July 30 puts that traded 14,790 contracts. Now, these were buyers. Now, I have an algorithm. I have real-time data that spots this for me, but there are other things that you can look at to help you identify certain things. So if you just take a look here on Thinkorswim here, and this is a paper trading account, we're looking at the put side here where 15,900 contracts traded in total and 70% of those traded on the offer. This doesn't tell you the full picture, but with me, I can guide you and explain this to you. So what we're looking at here is that these were opening buyers. These were opening positions that were positioning possibly for a move lower. Now, when I say possibly is because people can position themselves for a move lower for many different reasons. They could be protecting a position. So when you look at this type of order flow and looking at the put side, it's not advantageous other than when you're looking or versus then looking at the call side. And the reason why is because people only buy calls for one reason. They think the price is going to go higher. That's the important aspect of it. Now, on the put side, people could be hedging a position, and that's where things kind of get a little convoluted. However, when we look at something like this and we think about maybe putting on a position that is just a hedge against the market, and also thinking about this, what are we kind of hearing out of China right now? Well, we're kind of hearing that they may be locking down people or the economy may not be coming together as they anticipated. The problem with that is that there's money flooding the system. So is it really going to be something that prices are going to, back here looking at the chart, price is going to come crashing all the way back down to when they were in March? That's a 10-point drop from here. I don't know. There could be something going on here. Someone's buying a position, and again, the only way that they are paid on this position if prices do go lower. Now, I don't have this on here, but the 50-day moving average, the simple day moving average, is at 3305 or 3308, depending on how you calculate it. So if we just take this position here and we look at these puts, and it's mid-market right now is 65 cents, and it's under $1. That's what I typically look at, is something under $1, but 65 cents is a decent amount of change here. What's the payoff that we can look at? Well, right here we have a theoretical. And when we look at pricing with the shares at $35 and the put at $30, that's $5 out of the money. This is how volatile it is. They're actually pricing in a $5 move higher or lower. The market is. So that volatility is about 61%. And the implied volatility on these contracts alone are just right around there as well, 60%. So what we would look to do on this one, if you were bearish on this and you wanted to follow it just as a hedge, sometimes you need something just to offset your longs. This would be a perfect position, or just a speculative bet as what we're looking at here. Something's going on here. There's a large, substantial amount of money that was placed here. And the probability of this touching is when you look at the delta and you times it by 2, there's about a 44% probability that prices touch within the next 31 days. So trading range wise, it is a probability that on just a bit less than a coin flip, that prices will touch that 30 price. Now, it's depending on how soon it touches where we will see that payoff on these puts here. So one of the things I suggest is, instead of just trying to lob it out there with just a long call, is to buy the 30 for 65 cents and sell the 25 put for 20 cents. So you reduce that to 45 cents. Now, I did a little bit of forward math here, or forward theoretical pricing. And if we just did the pricing of these options, and we have just vol to just about 1%, because volatility will go higher once prices do go lower in this. So I moved it down $1.83, and let's move it up to 2 days. So on the 18th, let's just say the 19th. On the 19th here, the theoretical value of those 30 strike puts would be around $1. Now, the theoretical value of the 25 put would be at 28 cents. So from there, you backtrack. So if we paid 45 cents for it and we were able to sell it at 75 cents and within a few days, that's a good return. And what we're doing here is we're reducing our overall cost for the opportunity, and we're leveraging the asset by selling volatility further ahead. So they're very complicated here, but what we're looking more importantly is making cheap bets that pay off big money. Instead of buying the 65 cent 30 strike, or buying the 30 strike at 65 cents, and the payoff would be about $1. So, I mean, we're looking at about 30%. We can lower that to 45 cents, buy us more time, and get paid as well. So that's the trade I have for you today, and we'll see how this pans out. But we'll talk to you in a few days, and I'll have a new opportunity for you. So I look forward to speaking with you, and take care.